We are at peak inflation. Inflation is going away very quickly, and the Fed moves are working now. It doesn't mean that the Fed won't blunder and make this worse. I think they will. We can come back to that. But okay, so the inflation sort of came on the scene in mid-2021, in the summer 2021. By the fall, it was very high, and this is when Jay Powell was saying transitory, transitory, transitory. By November 2021, he threw in the towel. He said, okay, it's time to retire the word transitory, and then they started hiking rates in March. On March 1st, the policy rate, the Fed funds target rate, was 0. Today it's 4.25%. It's going to go up another 50 basis points on December 14th. So, and then the next meeting after that's February 1st. So they're going to keep raising over 5, probably get to 5.25%. That's in less than a year. I mean, we've gone to 4.25% in less than 8 months. But inflation is already off the top. It's going to come down a lot more. The markets are not ready for that. I see the inflation. I put gas in my car. I go to the grocery store. I see it just like everybody else. Home heating costs, eggs, milk, bacon, food, gasoline, etc. But there are two major sources of inflation potentially. One is the supply side. So supply shortages, supply chain disruptions, the kind of things we've been talking about. That's called cost push inflation. Costs go up and it gets pushed onto the consumer. The other source is demand, what's called demand pull inflation, which is more psychological. Consumers are thinking about choices and they say, I was thinking about buying a refrigerator, I was going to wait 6 months, but hey, the price is going up, I better go buy it now before the price goes up. In the 1970s, we had both. We started with cost push from the Arab oil embargo, but it flipped into demand pull in the late 70s and just spun out of control and Paul Volcker had to crush it. Today, the inflation is coming from the supply side, some of the things we talked about, higher fuel costs. Everything has to be transported, so fuel is part of everything. It gets built into the price of everything. There are other shortages and bottlenecks and costs that have to be taken up by manufacturers and distributors. So that's real. I'm not saying inflation isn't real, but it hasn't leached over onto the demand side. The psychology of consumers is not, gee, I better buy it today because the price is going to go up. It's like, no, I better save money today or watch my budget, etc. And here's the difference. Demand pull inflation feeds on itself. The more of it you get, the more of it you get. It does spin out of control. So the cost push inflation from the supply side tends to be self-negating. There's an old saying, the cure for high oil prices is high oil prices. So here's the Fed trying to deal with inflation, but they're dealing with it from the supply side. The Fed doesn't drill for oil. They don't drive trucks. They don't grow crops. They don't have farms, etc. The Fed can't do anything about supply side inflation except destroy demand. But here's the question: how much demand do you have to destroy to control inflation coming from the supply side? The answer is a lot. They're trying to get to a terminal rate. They're already there. They just don't know it. They'll be the last to know. So they're going to take rates to 5.25% or higher by March, but they're already at the terminal rate. They just don't know it. And so inflation is already coming down. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023, and no one's ready for that. People talk about recession, but it's going to be worse than they think.
And then they ramp up the printing press again, Jim.
Yes, but it doesn't work. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, you kind of just referred to it, is there a global liquidity crisis coming? The liquidity financial crisis is different from a recession. Sometimes you can have one without the other, and 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, 65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency, and that was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which for people not familiar with the Q word is 1,000 trillion. But there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. Deflation, it could be even with a very low nominal yield, it could have a much higher real yield in a world where prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse in 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company, it's down 90%. Cash will preserve wealth and then give you the opportunity to pick up bargains. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets.
I want to just bring up crypto here. Horrific year for the sector. Do you think that Bitcoin will still be around, Jim?
Eventually, no. It'll be around for a while, and it might, outperform some of the other cryptos. But still, I'm struck by the fact that I go back to the Gertrude-Stein theory. There's no there. And what's interesting about the last 5 years, and by the way, I say things like this, God, Jim Rickards, he's a dinosaur, he doesn't understand technology. It's nonsense. I read, Satoshi Nakamoto's paper. Within months of it's coming out. I've been in, gold, Bitcoin debates since 2010. I actually know a lot about it, which kind of brings me to my point, which is with nothing in the center, they replicated the entire structure of Wall Street. So you have exchanges, custodians, futures, options, settlement, clearance, lending, yields, etc. This whole Wall Street infrastructure, financial infrastructure, around nothing. I mean, Tesla stock, for example, maybe you like Tesla, maybe you don't. That's an individual choice. But at least they make cars. There's a real car there. And even intangibles, insurance companies provide services. There's something there. In crypto, there's nothing there. But they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange, or you own a lender set. Now that's all imploding. It's kind of a replay of 2008, except instead of, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and Morgan Stanley was hanging by a thread. It's FTX most prominently, but Genesis is kind of considering bankruptcy, etc. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, I have a lot more to say about it coming out of communications theory, but if I walk into a casino, put my money on the roulette table, and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure.